Welcome to the Market Call Show, where we discuss what's happening in the markets and the impact on your investments. Tune in every Thursday on Apple Podcast, Google Play, Spotify, or wherever you listen to podcasts.
Welcome to the Market Call podcast. Today I have Tom Basso. He's joining us again. Tom, if you're not aware of his accomplishments and his background, Tom Basso is a well-known American trader and an investment manager who's widely regarded as one of the pioneers of systematic trend following. Basso began his career in the financial industry in the 1970s and soon moved into the commodity futures trading realm. In 1980, Basso found his own investment firm, TrendStat Capital Management, which specialized in trend following strategies. And over the years, he's developed systematic trading approaches that involve the use of technical and quantitative models to identify and follow long-term trends in financial markets. Basso is perhaps best known for his work on portfolio diversification and risk management. He's a strong advocate of diversification across different markets and asset classes, and he's written extensively on the importance of risk management in the trading and investing world. Basso is a sought-after speaker and a lecturer on trading and investment topics around the world. He's been featured in several books and documentaries on the subject of trend following and has received numerous awards for his contributions to the field of quantitative finance. Overall, Tom Basso is a widely respected leading figure in the world of systematic trend following and has made significant contributions to the development of trading and investment strategies over the course of his career. I want to welcome Tom Basso, and let's get started. Hi, Tom.
Hey, Louis.
It's so good to see you again.
Same here.
So we were just chatting before we hit the record button on, you were able to see me, and I didn't know you were there. And I was reading the last chapter of your book, or one of the end chapters about the mental side of trading, and you saw me laughing.
Yeah.
There's just so many little gems in that last chapter, not to get too far ahead, but
I've been doing trading for like 50 years now or something. There's got to be more than one good story in that time period, and I've got a lot of them.
Yeah, definitely. And you have a new book. We talked a little bit about it in the last podcast that we did, and I was hoping that today we could really maybe talk about it a little more in depth.
Sure.
And by the way, when is that book expected to actually be released?
The target date, and so far it's holding, we'll see, is March 28th. That's the big launch date, and it'll hit Amazon and go crazy. And about a few hundred people have already indicated that they want it. There's no pre-sale, so they're just going to have to wait till it goes live and go in and buy it and drive it up the bestseller chart. But
yes.
Yeah,
well,
there's
the name of the book,
The All-Weather Trader, Mr. Serenity's Thoughts on Trading Come Rain or Shine. I think
Come
it is.
Rain or Shine. Yeah, that's a big part of it, the rain and shine part, because we tend to want to change what we do when we have the rain.
Yeah, and then that particular strategy, then when it's sunny, doesn't do well. Then we want to change it again.
Exactly. Well, I was, one of the first things that struck me when I read the book was that you said, or maybe I should ask you, what is the difference between a trader and an investor?
I don't see a lot of a difference. If you take some guy like Buffett or, these long-term buy and hold guys that get touted as being brilliant over their lifetime, they nonetheless have a finite time that they started investing, and they invested in some of these positions that made them a lot of money. And sooner or later, they're going to die and the position's going to be sold. So I think of them as a trader with a very long-term time horizon. I think the word investor, and by the way, if you take the mentality of a trader and say, I don't care how long, I'm still going to be buying, I'm still going to be selling, I still have to have a plan on how to deal with everything from the mental side of holding this position for decades, how I'm going to provide liquidity for other purposes from the portfolio if I need to. So this thing, if it's really illiquid and I can't liquidate it for a couple decades, I have to make sure I have enough liquidity other places. And of course, Buffett does. But eventually, the mentality of a trader, where if you think about it, you have to have a plan to get in, a plan to get out, a plan on sizing your position appropriately. Even Buffett wouldn't put his entire portfolio in one stock. He'll spread it around. That's just like every trader does. So to me, when people come to me and say, well, I'm not a trader, I'm an investor, that is an attempt for them to turn their brain off and make an excuse for their complete lack of a plan. So they just buy into something and then they just sort of sit there. And they have no idea how they're getting out. They don't have any idea whether the position's too big, too small. They've made all the classic mistakes of every trader. They've just done it over a longer time period.
Wow. The turning your brain off just struck me, because it seems like I could see that happening in people's minds, where they say, well, I bought it at XYZ price, whatever that price was, and now it's down 30%, but it'll come back and I'm going to hold on to it. And they'll ask me, what do you think of it? And you've been in this situation, I'm sure. What do you think of it? And then it's like, well, and then so they're asking for some kind of reinforcement of why they should hold it, rather than saying, right now, what is the rational thing for me in my situation, in my portfolio, with my goals? How does this particular position fit in that?
Exactly.
And your particular book, this book here, is very complete in my mind. It's short, sweet, and complete.
I tried.
And when you were talking about trader versus investor, that the first thing that struck me was that scenario where people are trying to differentiate between the two. And I know people that are in the business that are like value managers that they'll kind of tell me, yeah, Lewis, yeah, whatever you do, I've got the moral high ground because I'm scrubbing the balance sheet and I'm looking at the income statement, and therefore I have a superior strategy. But then you look at the results and you go, oh, really? Maybe not.
Yeah, maybe not.
Maybe not. It's possible, right? It is possible. And there's a lot of great strategies out there, but I think that it's important to understand that we are all buy and hold in the real world, like you mentioned, isn't really necessarily always working, right?
Well, if you think about it, buy and hold is a strategy. You got a strategy. It just doesn't have, it's incomplete in that. I think a true strategy that's complete would have what I call a buy-sell engine. And I call it an engine for a reason. An engine drives the car or pulls the car along. It moves it. A buy-sell engine should move the trader. It should say, I need to buy, I need to sell, buy-sell engine. So you need something like that to trigger your action. You need a way of saying, how much do I buy or sell? You can't just take your whole portfolio and put it in one position. You could, I suppose, say, oh, I'm going to buy 10 positions and equally dollar weight them. That is sort of a position sizing strategy. It's better than nothing, but there's lots of ways you can improve on that. And then there's the last and most important part is your own mentality. If you are going to come up with a strategy and then about a year later, you go into a bear market and you're sitting there, like you said, with the lady with the down 30% on her stock, and she's had no plan to get out of it. Now, what do you think of it? I mean, I don't have an opinion at that point. I mean, don't you have a strategy on what you should be doing now? Don't ask me. It's your strategy. And I think the mental side is what really kicks everybody in the teeth, because you get well along the plan, you're a year, 2 years later, you're getting bored from the position, and it goes into a 30% slide from an earnings miss or a bear market comes along. And then the buy and hold, quote, investor types then get a little nervous, and maybe that broker of mine or the financial planner, he doesn't know what he's doing, and he put me in the stock, and I'm going to blame him. I'm going to hire the next guy down the street as a financial planner to replace him. And of course, that guy's going to do the same thing the first guy did with a different set of ticker symbols probably. And you're going to repeat this whole process 2-3 years from now. And from an outside observer standpoint, you're just kidding yourself. You're just repeating the same dumb mistake over and over again by not having a plan and not dealing with your own psychology. The true way that you should have dealt with that, if you want to truly be a buy and holder, is to go back in history and study just something stupid like the Dow Jones Industrial Average or the S&P 500 and realize that when I was coming out of college in 1974, they had just finished a 2-year 73, 74, 50 cents on a dollar bear market for the S&P 500 in December when I just had come out in 74. And so I started out, I guess, fortunately, and with my first little $2,000 stock portfolio in a nice bull move after the bear market. But boy, that 50 cents on a dollar bear market really stuck in my brain. And for the rest of my life, I've been trying to manage risk and try to stay away from a market like that hurting me too badly. And I think a lot of people, especially the young kids that during COVID got their PPP money and opened up a stock account and bought AMC or something and are worth 6 digits in their portfolio now and have no idea what they're doing, of course. Those folks need a few lessons along the way to season themselves out because they don't have complete trading strategies and they're nowhere near mentally prepared for what lies ahead. But, I've seen enough bear markets now that I've lost track of them. I don't know how many I've seen.
Yeah. One of the things you say in the book is that, you basically ask the question, is there a perfect investment?
Yeah.
And a lot of people tend to think there is. You'll hear, a real estate person says real estate's the best investment, or somebody who likes gold or something. What is your philosophy on the perfect investment?
Perfect investment doesn't exist. It's a nice sort of, in my mind, kind of like a brain tease. It's sort of like golf. It's like, is there a perfect round of golf? No, because you can always get done and you're having a cocktail or something in the 19th hole and you're reminiscing over this wonderful round you've had, maybe the lowest of your life. And you could still say, I'm 15. If I just made that dumb 5-foot putt, I could have been 1 stroke lower. And if I hadn't done that back on the 6th hole, I would have been 1 stroke lower. And you can kick yourself about investing the same way. I got out of this stock too early. I got out of that futures contract too late. I didn't execute my stop when it should have been executed. And I stuck around too long, took too big of a loss. I mean, you can just beat yourself silly over all the different bad things you can do in your trading. And I think that's where I keep saying, there's the perfect doesn't exist. You can aspire to it and you can gravitate yourself towards it. And I did a lot of that in my early career because it helped me advance what I was thinking and how I was acting and how I was dealing with discipline and awareness and a lot of mental types of sides of the trading. And so I'm still not perfect, and I've been doing it 50 years of trying, but I think I have a grasp over what makes sense towards perfection. And while I haven't arrived yet, I'm closer to it than I was when I was in my 20s.
Yeah, you're very humble about it because, the smarter you are, the more you want it to be perfect. Like you figure, I'm smart. I want to figure out how to make this perfect trading system. So people tend to go through these cycles of learning and then realizing what they learned doesn't work, and then realizing that there's no perfect algorithm for anything. But if you make it a really beautiful dish where you're blending in the perfect spices and the perfect pasta and the perfect chicken, and they all have their own place, you have this beautiful meal in front of you. That's what it's all about, isn't it? It's about blending it together in a beautiful way where you have something that it's not perfect. No single one of those strategies that you put together is perfect.
And
but
you taste everything in the meal.
Tasty.
Everything is balanced, and it's like cylinders of the engine of the car or the motor of the car, and this cylinder's up and that cylinder's down, and they're all working together to pull the car, but they're all doing different things at any one point in time. And that's as close to perfection as you can do. But what you end up with is You end up with people coming in with one strategy, and it's going to really slay it over here in this market, and it's going to be killed in that market. And you can see the train wreck coming in slow motion, and they don't see it. And when it happens, they're wiped out or whatever. And they just don't have a total plan, and they're nowhere near a perfect investment strategy. But so far, I have not achieved perfection, but it's something that we all like to get to if we could.
Sure.
At least gives you a direction.
Yeah, it's like looking at the horizon. You never quite get there, but you're moving towards it.
Exactly.
One of the things that you talk a lot about is that each trader is unique. You know, there's a lot of people try to simulate or emulate another trader. I want to be exactly like George Soros or like Tom Basso or like, but then when you talk to each individual one of these traders or investors, you realize that they had their own path and they had to figure out their own puzzle, if you will, that you mentioned. Can you explain a little bit of what your philosophy is about that?
The easiest way for anybody thinking about, they're listening to this broadcast, take you and me, and we have different backgrounds. We have different amounts of capital. We don't have precisely the same computer skills or maybe math skills. We have different backgrounds. We have different people we know. All of that ends up being part of the process. So you're sort of you're asking yourself, if Lewis and Tom are completely different people with unique challenges, unique amounts of money, unique skill sets, how in the world would they want to trade like each other? It wouldn't make any sense, would it? I'd want to design what I do to fit my size of portfolio, my skill levels, my computer skills, how much time I can allocate to the process each day. And you'd want to do the same thing, and they're not going to end up at the same answer. And if we take that, extend it out to all the traders of the world, there's going to be as many traders in the world, that many solutions to all those individual financial challenges. So I like to think of it in terms of your financial puzzle and my financial puzzle. I have worked really hard to solve my financial puzzle. And like when people try to copy my hedge strategy that's on the website, enjoytheride.world, that's an example. That's an example of what I've created for me. You need to take that as a starting point and develop what will work for you. You may want something more sensitive and shorter time frame and quicker to react. You might want something less sensitive and slower to react. You may, instead of using SPYs, ETFs, and shorting them, you might want to use the ES futures, or you might want to use the NASDAQ. If you have a technology portfolio, you may want to find a Pacific Rim ETF that you can short if you've got a Pacific Rim portfolio. You can custom design whatever you do. Don't be limited to what I've designed for me. I have a very diversified portfolio. So an SPY or an ES futures hedge works very well and correlates well with my portfolio. So I do it that way, but it's not the only way to do it. I'm just showing an example. But people just feel, oh, Basso does this, so I want to copy him. Well, not necessarily.
No, I think there's principles behind what you do that should be copied. Yeah. The principle of position sizing, the principle of diversification, the principle of multi-strategies that are non-correlated that work well in different environments. Those are principles, and they can be effectively used. But to say exactly how I'm going to do that, that's another story, right? Mm-hmm. Like you were talking about the skill set and time to execute. I interviewed somebody, Brian Shannon, who is an excellent short-term trader. I will never trade like him. He's an excellent trader, but he uses volume-weighted average price, and he's in the middle of the day. And I know him personally. He lives in Denver as well. But it's one of those things where I told him I will never sit in front of a 3-minute bar chart. I just won't do it. So, so a lot of people who are practically investing, they have a career and things like that, and they want to take more control over their finances, but they still have obligations. So they want to use a strategy that maybe is a little bit longer term, but is still discipline that uses your kind of concepts of being an all-weather strategy. So maybe we should back up just a little bit more. We kind of went ahead of, I kind of got ahead of the whole concept of all-weather. Maybe you could just outline what your definition of all-weather is.
To me, over time, stocks, bonds, all the commodity markets, currency markets, precious metals, energy, everything out there has up markets, down markets, and sideways periods. Those are the three major categories. You could break them down even into more fractal types of subsets if you really wanted to work at it. But just to keep it easy in general, up, down, sideways. If you've got an up, let's say you're a long only buy and hold stock investor, to come up with something simple. That is a strategy, but what would you expect it to do? In an up 100% stock market, you would expect to be up maybe 90, maybe 110, maybe get lucky and be 140 or something, but you'd expect a good period. And then likewise, if you had a 50 cents on a dollar, 1973-74 bear market, or a crash of 87, or a tech bubble burst, or a real estate debacle in 2008, you're going to expect to have your buy and hold long portfolio suffer a great deal, probably 30, 40%. Mm-hmm. Now, if you understand that mentality, you say, that's cool, I'm okay with that. I really don't care. I'm going to hold this till I'm 50 and I've got decades ahead. It'll bounce back. I'm not going to worry about it. Okay, I'm okay with that. It's a strategy. You've analyzed the risk. You understand you're going to go into a drawdown every 7 to 10 years, maybe at the most. And you're okay with it. Okay, I'll second that motion. However, most people say they're okay with it and are not okay with it. So what I try to get to with all weather is to say to myself, all right, let's see, how about if I want to try to take care of up, down, and sideways, how about if I'm going to do buy and hold, how about I come up with a second strategy we call a hedge strategy? That strategy is going to trend follow some kind of an index that's going to match up well with my portfolio every time the market starts moving in a down direction. It's only going to take short positions, never long, because I've already got the long side covered over here in this other strategy. And when I marry those two together, now haven't I made it a bit more all weather? Because now it can make money when it goes up because I'm going to take the hedges off. And the market starts trending down, I'm going to put the hedges back on. I'm going to try to buffer that portfolio. And when I do that, I'm going to try to protect those assets. So now my equity curve gets a whole lot flatter during the down markets, and then it skyrockets upward during the up markets. And all of that might be a little bit more psychologically easy to deal with when you're thinking long term. You don't go through these 50% downs in your portfolio that can shake you out of the strategy. And then to take an extent further, you say, all right, well, let's see. If the market goes sideways for a year, there's been some periods where a couple of years it's gone sideways. And that's a lot. That requires some patience in today's world of Twitter. Gives you the news like instantaneously. 2 years seems like a lifetime. So how about if you develop a strategy? It's a third strategy that's something like collects credit spread on option premiums, or comes up with a way, does iron condor spreads or something that you could put on once a week, not take a lot of time with, but is going to make its highest profit during a sideways action as opposed to a trending market up or a trending market down. Now you have something that's trying to produce profits during that period. So you're getting even a little more all weather. You got up covered, you got some down covered, you got some sideways. And then you might ask yourself, well, why am I just trying to break even during down markets? How about if I come up with some strategy that tries to exploit down periods and does it quickly? And so you start adding on a fourth strategy, and I'm up to 9 now. And with automation and some thinking through what you're doing, and sort of, even if you don't have automation, I believe I did run the 9 strategies without a whole lot of computerization. Now I have computerized it more and more, and I probably got myself down to today about 40 minutes, and I hope to get it down to 15 to do 9 strategies. But it's taking me a lot of years of working with some computer people to define how we're going to create that code. We're up to 100,000 lines of code now to do a lot of the intricate things that a human being can do easily. A computer is pretty stupid when you think about it. You have to teach it all the little minutiae. It's difficult to debug and make sure that everything's performing. But I think what I'm getting at is, even without computers, if you simplify what you do and you don't have 300 positions that you're trying to track, you should be able to once a day get down to maybe a half an hour or less of work, go through it. You've already know what you got to do. You got your indicators on the charts with your broker platform. It shouldn't take you that long to get through your strategy for the up market, your strategy for the down market, the strategy for the sideways. You're done for the day. Go away, play golf.
Yeah, and it takes a lot of stress off of you. For example, a discretionary trader who's sitting in front of the screen a lot, if they're a short-term time horizon, there is a lot of mental stress, and it's not for everybody. One of the things that you mentioned was that you traded it by hand, or not by hand entirely, but you had all your indicators, you saw what the signals were, and you probably manually entered in your orders every time. I think there's an advantage to doing that, because what happens is you learn all the little intricacies about why a system doesn't work, or what you need to change with a system and how to computerize it, or what you need to clarify, because you'll get into this little fuzziness area with your system.
Yeah, you'll find, because you have to instruct the computer eventually how to do that. If you decide to automate it, if you've done it yourself by hand, you'll find yourself more than capable of describing to a programmer, or if you learn a little programming on your own self, to be able to instruct this completely dumb machine how to take that piece of data and then consider whether it's higher or lower than this piece of data. How does it find that other piece of data? And you as a human being can look at a chart and say, well, that bar is higher than that bar, or this candle's lower than that one, or this candle's outside of the previous one. And you can easily, as a human brain, know that, but you have to define what is an outside day or an inside day or an up day or a down day, or all these different things. A higher volume day, what does that mean? Computer doesn't know. And
yeah, what is higher volume? And one of the things I noticed about your strategies that you did share in the book were, it was very clear. Like some of the indicators, all the indicators that you use are very clear, and there's typically a band around it, at least for the trend following elements of your strategies. A lot of times people will create a trend following indicator, and it's not as clear, or you'll have a bunch of other problems because you don't have a band.
Exactly.
Because you can have whips around, and so it's clear. Are you going to be able to catch it quicker? No, you're going to have a different system. But if you're piecing it with something else, that's okay. Or you could tighten your bands up. But having that clarity of knowing exactly what that rule is, if you're doing it by hand, you'll be forcing yourself to also do that, because as you're doing it, you'll say, well, wait a minute. If you're logging, I'm trying to give some tips to people who are trying to do this, just from my perspective. Write everything down that you're doing, and then try to say it in English. And then when you talk to the coder, they'll inevitably come back to you and say, you know what? You said this, but what about this?
Yeah.
There'll be like 3 little pieces that you didn't define.
Well, one of the reasons why it's taken so long to develop some of this stuff is the last one that we're trying to automate. It's pretty complicated. I get a little bit of brain strain when I'm doing it, and I've written it down in what I think are clear terms, but they're still puzzling over that in the programming area there. And they're working on it, and we'll make some progress. They've been distracted by some other data crises along the way that has distracted their attention, and we'll get back to it, and we'll eventually solve it. But yeah, what you said, a simplest example I can think of without the band would be a simple moving average. Say you have a 10-day moving average going back and forth over, say, a 50-day moving average. There is the mathematical possibility, however remote, that you're going to get the change in the 10-day going through the 50, and a few days later it turns and goes down through the 50, and then in few days later it goes back up through the 50. The 50 is going sideways flat, and you're getting these buys and sells about every 3rd day, and you're thinking, wow, I was supposed to be trading long-term and I've just done 3 round trips in the last week and a half. That can happen because mathematically you've set yourself up for that. As soon as you give it a noise band, then all of a sudden that goes away because you've given it that room to move each day with a little bit of noise band. Mm-hmm. And that's why I prefer the things like Keltner and Donchian and Bollinger and those types, because you're getting that noise that you can ignore, and the information part that you take action. That's your buy-sell engine. So the top and bottom lines are encompassing the noise, and you're saying to yourself, I'm going to ignore everything between the lines. It's just useless information. It's noise. And anything that gets above the top line, I want to do something. That's buy-sell engine, motivate me to buy. When it gets to the sell line or the bottom line, it motivates you to sell. And you're just going to let the in-between just happen. And you could spend a lot of time in that in-between. I've had markets that get stuck in the mud and they don't ever get out of that. And what will happen is those lines will get closer and closer and closer together because you're in lower and lower volatility, and the Bollinger Bands get less standard deviations. The ATR goes down, so the Keltners get tighter. The top and bottom range of the prices gets tighter, so the Donchians start squeezing in, and you start seeing yourself getting very tight to the market. That's when you could have a big breakout, and all of a sudden it's off to the races again, and you're back to normal and making money or whatever. And I think you got to really understand the math of whatever you're doing, the logic. And you got to ask yourself, what is the mathematical Achilles heel of what you're trying to do? What could happen in the market that would cause this to just be just a struggle? What would be a worst case scenario? How could I dream up a fictional story that I've never seen in history, but that'll destroy this particular strategy? It's very insightful to ask that question.
Mm-hmm. Yeah, then or if you do a back test, you could look at those periods of time where there's big drawdowns. So if you just run a Donchian breakout system on a group of, say, 50 futures contracts long short, you'll find drawdowns that last years. And you could go in there and say, why? You can optimize to it even, and you still will have big drawdowns for a long period of time. And you can say, what's going on there? And inevitably, you have this concept of filling the potholes during those periods of time. I'm using trend following as an example. You could use the same example for a long only stock investor. So maybe you could give me some color on how you attack that filling the potholes.
What I do is, and I have to give full credit to Lawrence Bensdorp here. He's the one that came up with the term that I use all the time. And it's instrumentally crystallized my thinking about how you're trying to develop new and important extra strategies to add to your mix to become more all-weather. You can look at any equity curve. So whatever you've got now, whether it be one strategy or 2 or 3 or whatever, it's going to have some drawdown periods. So imagine that as a line going up the page. That's your equity curve. But all these drawdowns are like potholes. They're little dips down, and then you recover to new highs, and more dip down and new highs. And each one of those potholes is a period of time where your mental psyche is going to get tested, and you're going to try to start doubting yourself. And, that's when a lot of things go screwy. So you'd love to fill those potholes and make it just a straight line going up the page. Well, it's not that easy. That would be the perfect investment, and we've already established that doesn't exist yet. Mm-hmm. So you're trying to get closer to it. So I look at the pothole, I take my biggest one, and I like to go in and analyze what contributed the most to that, number one. And secondly, I ask myself a question of, if I were just trying to create a strategy that would do nothing but make a lot of money during that type of period, what would it look like? Forget the rest of the time. I'm just going to concentrate on the pothole. And, I'll come up with some just out of wacko ideas. I might come up with 3 or 4. And then you say to yourself, okay, let's test those and see how they would perform, and what kind of math are they using, and what would I expect them to do during the rest of the non-pothole periods. because if I'm making money during the pothole, I may be losing a little bit during the other periods. But as we've already established from the equity line going up the curve, I'm doing all right with the rest of my strategies during those periods. So I could afford a slightly lower return during those periods, sort of paying insurance so that I more adequately fill that pothole and cause me less stress, improve my return to risk ratios, give me a better chance of having that longevity, of having the mental mindset to stay with what I'm doing because I'm brushing it off. Everybody else is going into one of those potholes and abandoning what they're doing. And I'm just cruising along. Maybe I got a little pothole, but it's no big deal, and ready to recover after that. So that's the game I play with myself. I know my own tolerance after this many years, and I try to get to the more perfect all weather. I'm trying to take those potholes and develop ways of dealing with them that make sense.
Yeah, because the name of the game is building the capital and your wealth. And if you abandon something at the wrong time, then you're defeating your purpose.
Then you're starting all over again. And I find people that do that, they shoot themselves in the foot doing it, and then they go right back into something else because you got to have your money managed somewhere. Mm-hmm. You can't just put it under the bed mattress. And I find them rushing off to the latest hot track record that they saw in a magazine or heard on a podcast, and they're doomed to repeat the same mistake all over again a few years from now, and they never learn.
And you mentioned paying a cost of insurance. This is something that I think some people have a problem with. They say, wait a minute, my net cost of that hedge strategy or whatever it is, was 200 or 300 basis points. Why would I do that? Well, when you put it together, your Sharpe ratio is better and the ride is easier. And, sometimes paying a little insurance is good. What's beautiful about managed futures is that it's a net positive and still has some of those same characteristics.
Correct.
So in your strategy, you have both the hedging, which may have expected to have a net cost overall, but is going to help a lot when times are really rough because you've got this long side of the portfolio. Right. But the managed futures side will also tend to give you positive returns when you have those potholes in the equity markets.
And then by doing the futures overlay on the stock side of the business, I'm allowing my capital to be used sort of twice in a completely non-correlated fashion. So I'm smoothing things out, improving return to risk ratios, and reducing those potholes. And I think it's all, you can see I start adding all the different strategies in the back of the book and showing the effect of adding the next one and adding the next one. You can just see how the portfolio, starting from a simple sort of equity timing sort of approach with its drawdowns and its potential returns, gets smoother and smoother and smoother and smoother. The return to risks keep climbing. The potholes get smaller. And that's it's sort of the autobiographical story of my trading life, starting from what I did way back when I was in my 20s and had no clue what I was doing, to sort of the logic that I used as I discovered things and I thought of things. Let's add this. And I try to explain why, so that people can sort of follow the mental process that I was going through, because they may not want to follow the same things, but it may give them some lessons in how they could think through their own evolution as a trader and maybe speed the process up a bit so that they can get closer to all-weather trading themselves with their own personalized set of, indicators and strategies that work for them.
That's exactly right. So for somebody who's starting to build their own strategy, this is a great book to go to and you'll get ideas all throughout the book, even if you've been doing it for 27 years like I have. Yeah, I got a lot of ideas from
it. Even experienced traders will have at least one aha moment while they're reading this. I threw the kitchen sink in this thing. It's everything Tom Basso has in his brain, I believe. There's very little that I left out of there. There were some things that I couldn't even figure out how to explain, but for the most part, all the critical parts of everything I've learned and done over my entire 50 years of trading are in that one book. And it's some 200 and something pages I tried to write it in elementary level grammar. I didn't use a lot of multisyllable words, if you know what I mean. I didn't talk about ketose or kurtosis or standard deviations or a lot of statistical terms, skew. I don't
I
think I
think the
mentioned
worst
the
one
word.
is heteroscedasticity.
Now, that won't be found in this book. If anybody's read my Substack pieces, it's done in that tone. It's like just Tom talking to you. I don't try to make it fancy sounding, so everybody, even a newcomer, could probably get a sense of what I'm talking about. That's what I was going for.
You know, and I think what if people read this book, when they read this book, if they're limiting their tools in any way, they'll have an aha moment. Because one of the things you talk about is, why should we limit ourselves
Sure.
in just, I'm only going to be a long only stock investor, or
Right.
I'm going to be only approaching the investment from one perspective. You can do that, but know that there is a cost to that. And so maybe you can give me some ideas, or give the listeners some ideas about how they can start thinking to themselves about expanding their horizons and how they invest, like, for
Well,
example, futures and
yeah,
shorter term trading and things like
we
that.
can use me as an example. I was running a long only to cash stock management firm, a registered investment advisor in St. Louis back in the day. And I looked at that and I said, the 73, 74 are still in the back of my brain here. What happens to this business and the employees we've hired and the lease payments and all this stuff if we go through a 2-year bear market? Aren't we going to not only lose fees because the value of our assets managed goes down just with the market going down, and then probably some clients aren't going to like that and they're going to leave, so now our assets go down even more, and Susie over here, we're not going to have enough money to pay her, and Joey over there, we're going to have to somehow figure out a way to cut him back or let him go too, and we're not going to need this particular office space, so we might have to downsize the office. And I'm thinking, this is not a great business model.
Yeah.
So I said, well, it's the same thing for an individual investor. So I started thinking to myself, if the stock market went through 2 years of a disruptive move to my portfolio, what out there in the liquid world could have the potential, at least, not necessarily a guarantee of producing a profit in that environment? And when I looked at bonds, there were times in history where bonds and stocks both go down. We've just been through one last year.
Yep.
So if you're a 60-40 guy and you're 60-40 gung-ho for the rest of your life, good luck last year. You had the worst year in recorded history, or
long time
back to the Depression or something.
Yeah.
And it was probably very trying on the patience level. And so I looked out there, and the first thing I noticed was that if I could trade something that had nothing to do with the stock market, I might have a shot. So I started thinking about silver. I tried to think about, well, there's all these gold bugs out there. What does that involve? And what could I do there? And of course, gold bullion and silver coins and stuff, that's a little clunky, especially from a management standpoint. But futures, I can call a broker, buy and sell a futures contract. I can roll it. I can go short and long with equal ease. It's inexpensive to trade, commission-wise, to control a substantial exposure to one of those. And so that started me on this quest of looking into futures. And then I realized, oh, wow, there's lean hogs, there's corn, there's crude oil futures contracts. Man, I can get far afield from the stock market and have the ability to go long or short. So it really, I have the potential to make money anytime at a moment's notice. So during a bear market that might last 2 years, where there was substantial movements, I have an above average probability along the way there of hitting a market that's moving also. Might not have anything to do with the stock market, but it moves, and I can be in on it and be trying to produce a profit to essentially offset some of my stock losses. So we immediately added a futures program. And when I broke off from that firm and went to Trendstat Capital Management, a firm which I controlled then, that allowed me, I registered as an investment advisor and a commodity trading advisor. And eventually the futures side is what I became famous for, and the currency trading in the later years. And that's what most people know of me as. But I started out in the stock business, and the stocks eventually just faded away to nothing. And we finally closed it down in my later career. But yeah, I'm just trying to solve a problem, and I end up, solving it well, and it ends up being a mainstay of my life. So I think individual investors can take that same mentality into their portfolio.
Yeah, there's a little bit of a learning curve.
Mm-hmm.
And the main thing is understanding how to manage risk and how to size, having enough capital to do it. If you don't have enough capital to get the proper diversification, you won't be able to do it effectively. You could, but it would either your volatility is going to be super high, risk of ruin gets too high, or
Right.
you won't have enough diversification. So you'll have, you might have orange juice take a big run up and then, or move against you, and it'll mess up your performance. But
Exactly.
I want to, Katie Kaminsky, or she coined the term crisis alpha.
Yeah.
And she was talking about managed futures.
Mm-hmm.
And she was on a podcast recently on Top Traders Unplugged. You may have heard of that
Oh, yeah.
podcast. And she had mentioned that there was a few different things that are required for you to have crisis alpha. One would be liquidity. I'm kind of going by memory, but one would be liquidity, and the other one would be like total flexibility to move in and out, and then the other would be to have massive diversification. And if you look at those three criteria, it's futures. It's
futures, and it's trend following of some sort.
Mm-hmm.
Yep.
And so it's a little bit counterintuitive for people, but the value is definitely there. And there's a learning curve. But if you get past the learning curve, then if you want to do it yourself, you can do it. Otherwise, you could go into certain funds out there that do a very good job of doing that for you. So if you're that type of investor, you can construct your portfolio that way.
Exactly.
So
go find them and buy them. I'm chairman of Standpoint. They've got 50% futures and 50% equities, and they trade in like 75 futures markets. And they got a really 5-star rating in Morningstar, 570 million under management, doing well. That's an alternative. BLNDX, the ticker. Yeah.
I just recently interviewed Eric.
Yeah.
Had a great time interviewing him because it's so funny. We were so close to it's amazing we don't even know each other.
Oh, really?
Because we were around the same people doing similar types of backtesting and stuff like that back in the 90s, early 90s.
I've known Eric for probably 30 years now. He actually applied for a job at Trendstat Capital back in the 1990s. And I turned him down with about a 4-page rejection letter, giving him all sorts of suggestions about what he should do and what's important and what isn't. And he took a lot of that letter to heart and created a lot of stuff. He eventually moved from up in the Midwest down here to Phoenix, and he lives, probably 10 minutes from where I am right now. And so we have lunch every now and again, and he's one smart cookie. I tell you what.
Yes, he is. He's very smart and focused, and he's got an excellent process, in my opinion, over in that fund.
He does.
Check out that interview if you didn't.
I will
didn't listen to it, because I think we went fairly deep into it in that compared to other interviews I've heard him do. But I kind of wanted to go deep with him because he's got a great mind for going, to explain those in a way that people can understand.
He can go so deep you won't even understand what he's talking about.
I believe it.
He's one of the few guys in the world, after all my years of experience and my math knowledge and computer skills, that I have to really listen well at lunch when he starts going off deep into some of these topics we get into. I have to pay attention. And there's not too many people I got to say that about.
Yeah, absolutely. So when you were talking about the complete strategy, that was one of the most valuable chapters, I think, to me, because you see different types of concepts of what a complete strategy is. They don't use the term. People don't use the term complete strategy. I like that term, complete strategy. Can you explain why you need a complete strategy, and what are just some of the basic elements without having to get into every detail?
The three most obvious I usually say are the buy-sell engine. So motivates you to buy or sell. That's one part of a complete strategy. The second one is how much do you buy or sell. So that's the how much or position sizing section of it. And that includes not just the position sizing getting in, but it might be the position sizing of what you got to have like a year from now when you're still in the position, but things have changed. Do you want to hold that same position during that entire time frame you own that position, or should it be modified along the way to suit your portfolio? And then the last item is the ability to have the mental side covered. So that could involve stuff like mental rehearsal. You're setting everything up, and you got the first two in place, and you're a day trader, and you're into a beautiful trade, and it's going your way. And you get a call from the school saying your kid's sick and in the nurse's office, could somebody come pick him up? And you're nominated. Did you plan for that within your trading strategy? You should know exactly, okay, I know what I need to do. I need to blow out of this position. I need to make sure everything else is good and grab my car keys and go pick up the kid. You have to think through those things and mentally rehearse them. And then you can think of a million other things, like the power goes down, the internet goes down, your broker goes down, you go down, you're sick, or you have a heart attack, or you get in a car accident and you're gone. All of those things are part of life, and life is sitting out there waiting to intrude on your trading every chance it can get. And so the mental side, it involves not only dealing with the ups and downs, not getting excited and greedy when trades are going your way. Not just because you traded down a profitable day doesn't mean you get to go out and have wine and a steak dinner. It's just another day in the funny farm. You just take it in stride, and that pays for the next day that you're down 30% or down, not 30%, but down like 3-4% or something like that. It's a really bad day. You don't kick yourself about that either. You followed your strategy. It's all part of the game. And you just keep going, and it's day after day, and it's routine, and it's your next 1,000 trades, and it's just the process. And you got to get that mentality complete with everything you're doing, and the space that you can be in, and the noise environment, and the lighting environment, and the computers that you need to do what you need to do. You got to get it perfect as you can. And then all three of those things, if they're all there, I would call that a complete trading strategy. There's offshoots of that, like if you're in stocks, how do you screen the stocks? That might want to be in place, but that's sort of part of your buy-sell engine, in that you're trying to find the candidates to then buy and sell. But it isn't strictly a buy-sell engine in my book. It would be more like screening tools. But so there's offshoots of what you're doing that might enter into how it affects that complete trading strategy. But those three things are pretty darn important and have to be there. If any one of them's missing, you are going to struggle automatically. If you don't have a buy-sell engine, you won't know what to do. You'll just sit there watching charts all day. You'll never make a move. If you start buying and selling the wrong amount, you're going to road to ruin. You're going to put too much on one, not enough on another. You're going to blow up. And if your head is all screwed up because you're letting life completely manipulate your trading, and you're missing your time window to run your daily process, or you're a day trader and you get called away, or the internet goes down or whatever, you don't have a plan on what to do, you're gonna fail that way. It's going to affect the other two. So any one of those three pillars, you're dead.
Yeah, that mental side is one side that I think is unique in that concept, because the mental rehearsal part of it reminds me of a quote that Dr. Van Tharp had: "Traders don't trade the markets; they trade their beliefs."
Right.
And when I first read that, I read it in one of his books, and You mentioned that in your book, but you put your own personal spin, not spin, but your own personal experience in that,
Yeah.
which makes it more valuable. But when I first read that, I was like, I was younger, right? And I was like, what do you mean your beliefs? It's either going to go up, it's going to go down, you're going to buy it, it's going to work, or it's not going to work. And then over time, the older you get, the more trades you make, you realize that's so true. You have to have a belief in each one of your strategies. So if you have all these strategies that are out there, what are the beliefs that are associated with each one of those? And knowing that there's no perfect system. And so you understand why something works. And when it's not working, it's because those conditions are not in play at that moment.
Correct.
I feel like the biggest part of this book that struck me was the mental side, for me personally.
Uh-huh.
And I hope other traders get a hold of this and just read the book, because there's a lot of good ideas all throughout it. It's not super technical, but it's technical enough. When you get into the middle of the book, there's a bunch of strategies that you really detail out. Like, here's the calculation, here are the parameters. So if you don't have a lot of knowledge about like just the basic structures of how to do a trend following system, you'll get some of that.
Yeah.
So you'll get enough that will get you a start to go and do your research. So it's really, I would say it's really for anybody, seasoned or non-seasoned.
I started out thinking I've got to make this. I've got new traders that have never traded before that, are following me on Twitter, and I've got household names in the trading industry following me on Twitter. And so I wanted to make it a book that had a lot of just great stuff in there for anybody. So if I'm having a conversation with somebody that's a newbie, I'm going to have a different level of conversation, and I'm going to have to gear everything I say to that level. But if I'm talking to you, for instance, who's been around and has gray hairs like me, what do I say to Lewis that would cause Lewis to pause and, like you did before we started the interview, laugh or chuckle and say, yeah, that is so important. That's exactly what, that was a good statement that he made. And I think that's what I was trying to get to, and hopefully I've achieved it. I mean, I'll tell a story on myself. I'm not, spectacularly emotional, but when I reread my book for the last time before I shipped it off to the publisher, I got to that last paragraph, the closing, and I broke into tears. I teared up. That's awesome. Just thinking, this is what I was going for. I was really happy at that point that I had finished. I was relieved that it was over too, because it took me probably over a year to put it all together. But with all the examples and tables and charts and everything, there's a lot of work to do that book. But when it was all done, I thought, yeah, this captured exactly what I was trying to do. So I'm really pleased the way it came out. I hope people find it as useful as I hope they will.
Yeah, get the hardbound book, put it on your shelf, read it, devour it, use it, put it on your shelf. For those,
and then read it again.
And then read it again.
And then tell your friend about it. And have them go
exactly. Well, Tom, thank you so much. Hey, is there anything that you're working on, or any projects or anything that you want to share or anything like that?
The only thing I'm working on aside from that, and aside from I just bought a new house, so we've got a 6 to 8 month remodel that is major remodel. We're basically ripping the inside of the house apart and putting it back together and bringing a 1999 home into the 2023 genre. So that's going to keep me busy for the next probably 7-8 months. And then aside from that, I'm consulting on a trading platform that I see as being the ultimate easy thing to use for a new trader, a subscription-based model in the cloud, reasonably priced, with a lot of different choices on indicators, a lot of different choices on position sizing, and that can run historical simulations on data that's already available within the system. So you don't have to go out and track down data and deal with all that. And at the same time, when you get done with simulating, that you'll be able to then go to a broker, open a brokerage account, and actually ship orders each day to the broker. And that would give you a kind of a great support structure to start out as a trader and say, okay, I'm going to do something simple. I'm going to start with $10,000. I'm going to do something this easy, and I'm going to use this ETF or 5 ETFs, whatever. And I'm going to use this buy sell engine, and I'm going to size my position this way. And I can run simulations and play with some of the parameters and decide, all right, this feels comfortable. I can do these many trades. I'm not that busy. I can't do my day job and do this on the side and then ship my orders each day. And it's pretty easy. I can do this in 5 minutes a day, and I'll just pay the subscription price. And that way all this stuff's taken care of. And I hope that this might be out this year. I'm in alpha testing now. 6 of 7 strategies are now automated. My 7th will be done shortly. And when that's done, we're getting closer to beta testing. We'll do that for who knows how many months until the beta testers are happy. And then we're ready to go live. So I don't know when exactly it'll be. I hate to predict, but should be coming out later in the year, I hope.
Is there a name to this project? Or?
It is. It's SimTrader, SIMTRADER, simulation and trading.
Got it. So I saw that in the book. I Googled it. There wasn't a lot of information on the website yet, and I had a feeling.
I'm trying to make it, with the book All Weather Trading, as you probably got a sense of, I'm trying to make trading a lot easier for people to try to understand what are all the pieces and how can I put that together. And then with SimTrader, I'm really trying to get to a point where I've put those pieces in place, sort of hardwired them together, and have them a lot of different types of ways of dealing with these different, the 3 things, the mental side, the dealing with the position sizing, dealing with the buy sell engines, overbought, oversold condition indicators, those types of things that you don't have to run to Investopedia and then go get a spreadsheet and then try to program it. And then you don't know where the data is coming from, and it's all clunky, and the data's got problems, and it's overwhelming for the new trader. So they don't do everything properly, and then they fail, and they don't even understand how they failed, but it gets to be burdensome, and then they give up. If I can make that all come together and click this box and click that box and put in this parameter and try it and just run it and see what happens, and you get a nice chart out and you get all statistics, and you can say, okay, that's a good starting point. I could live with that. But what happens if I change this number or check that box instead? And you get a different result, and you can have a toy to play with for a while. And then eventually you say, I'm tired of playing with my toys. I'm going to do this real world. And then you've got the ability to do that. So I thought that would be a great legacy that hopefully lasts way beyond my lifetime with any luck, and kind of something I can give back to the industry of traders that they can use as a tool in the future.
Yeah, it's like empowering people to get going in this concept with a lower barrier to entry, because
it'll have futures and securities will be in there, so you can go off into the futures world without going through some of the pain that you need to go through.
So now I have a sense as to who your broker is.
Yeah, well, we will be limited. The first version of this will probably be limited to Interactive Brokers, but we may, be able to expand into other brokerages as those become available. It depends on how good the what's called the Automated Programming Interface, or API, and how easy that is. Interactive Brokers has an excellent one, and we've used that as our guinea pig, so to speak. But there may be some other brokers we can tie into as well. But we thought we ought to walk before we run, and we're just trying to get.
This is really powerful for the individual investor. I mean, like for people in the industry like us, we use trading platforms that will go to a lot of different brokers, and they have APIs that go to each one of them. But we pay a lot of money for those. Yeah. So you'll be, as an individual investor starting off, and they'll be able to do that without spending $15,000 a year, or whatever the number is.
So multiple systems trading, no issue. Futures, securities, no issue. Data, no issue. Broker, no issue. Send the orders, no issue. You can.
It's a no excuses platform.
Yeah, you put in your credit card and sign up for the basic program or whatever, and off you go. And we're trying to make it that simple. I look forward to that being done, because when that's done, I have no other projects on the horizon. I may go back to being retired.
Oh, there you go. Yeah. What is this retirement stuff? Yeah. Yeah. I think when you initially retired, I remember when you initially retired,
Yeah.
you were pretty, you laid low.
Oh, I literally stayed in money markets for 12 months just to rest. I didn't
Yeah. You
even
must have had
trade.
yeah, it must have been quite an experience getting through that.
No, it was, I would go out in the backyard and do Italian pruning on my beautiful flowers. I had my whole garden in back in gorgeous blooms all the time. When Brenda and I got married back there, the entire yard was like a botanical garden. I worked out every day. I played a lot of golf. No, I had a great time. It was a wonderful year.
It's almost
It,
like you rejuvenated yourself, like you needed to rejuvenate yourself. And then you got a second wind that brought you to a new level or a different purpose, I guess.
yeah, here's what happened is Brenda came to me and said, well, now that we're getting married, I suppose you ought to look at my portfolio. You probably know more about doing this than I do. So I did. And I said, okay, well, if I'm going to start managing your portfolio, I might as well start managing mine along with it again, because I'm going to be doing it anyway. Might as well, what's the difference between 4 accounts and 2 accounts? So I started up trading again, and then I started designing everything for the technology and the time commitment and the skill levels that I had to solve those financial problems that we talked about earlier.
Mm-hmm.
Custom designing everything. I treat her portfolios different than mine because it's a different size of capital and a different problem to be solved. So fine. But I custom design things that she does. I custom design things that I do. And one thing led to another. And as I was trying to help family members with hedging techniques and ideas, all of a sudden social media started perking up that I was helping my relatives, and people started telling me, well, why don't you put it on Twitter? And we'd love to see the signals too. So I started putting it on Twitter. And then one day I came into a whipsaw trade, and I got out of the whipsaw, and I said, well, now we've whipsawed out of the hedge trade, and now we're making a whole bunch of money to the upside. Enjoy the ride. And I got such an unbelievable reaction from enjoy the ride that I started using it. And now people use it routinely at the end of their posts all over the world now. And sometimes they'll say, as at Basso Tom says, enjoy the ride at the end of their post. And of course, I didn't copyright that, and I'm not going to. So everybody's willing to, you can use it any way you want. But it's kind of what's happened is now I've become an educator, and it's something that I got sort of dragged into a little bit, but I've embraced it as if I'm going to help a lot of people, it's very satisfying. To write a book that I know people, or I hope at least people will be have benefit from, and I'm leaving something. I'm not going to be around forever, and I was trying to write a sort of a classic book that would have so many different gems in there that it could last, decades. And so that's kind of where my role is now. I'm the gray-haired old guy that used to be a new market wizard and run 28 years worth of Trendstat Capital Management, turned into a website educator, kind of Twitter guy, make an occasional article on Substack if my mood strikes me. And I still try to get out and play golf and prune my gardens and that type of stuff, but there's less time for that because I'm so darn busy consulting and helping people and doing posts and Substack pieces and stuff. But
well, enjoy the ride is your brand. So it's too late. Somebody could try to put a trademark or whatever on it, but it's too late. I'm just saying.
Yeah, I'm kind of locked into that brand, I think. I think more people.
It used to be Mr. Serenity,
yeah,
which is nice. It's nice.
I still get Mr. Serenity. It's used as the subtitle of the new book. People still call me that. I had a guy in a comment today call me Mr. Serenity. It's stuck with me since Jack Schwager gave me that nickname. That's stuck with me for some
in that
20,
Market Wizards book.
What would that be? 23, probably 30 years now I've had that nickname. And so that kind of stuck, and enjoy the ride stuck. And so I've got several different nicknames and monikers that
I almost feel like you have a mean reverting mental attitude. So if you're feeling too
I have
good,
never-
let's bring it down. If
That's a
you're
good
feeling
one,
horrible,
Lewis. I've
let's bring it
never
up.
heard that before. A mean reverting mental attitude. I got to use that. That's great.
I'm pretty sure that's what you have. You bring yourself up when you're feeling down, and bring yourself down when you're feeling too good, because otherwise those two emotions will knock you out of the game.
Yeah.
So
no, you're absolutely right. I kind of do. I never thought of it in those terms, but I sort of do have a mean reversion mental attitude. I have to use that in a future Substack piece.
there you go. Well, Tom, thank you so much for your time and your generosity and all of the learning that you're helping people with. And we will strive to enjoy the ride with you.
My pleasure, Lewis.
For the latest episode of The Market Call Show, make sure to like, subscribe, and follow us on Facebook, Twitter, and YouTube. Go to marketcallshow.com for all our past episodes and sign up to get alerts for new episodes. If you enjoyed the content of this episode, please leave us a 5-star review and comments. The information in this podcast is informational and general in nature and does not take into consideration the listener's personal circumstances. Therefore, it is not intended to be a substitute for specific, individualized financial, legal, or tax advice. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a final decision. WealthNet Investments is a registered investment advisor. Advisory services are only offered to clients or prospective clients where WealthNet Investments and its representatives are properly licensed or exempt from licensure.